Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done. When you're in need and don't know where to go, pick up the phone and call mom.
All right, so welcome to Mortgage Mom Radio. I am Debbie Marcoux. I am the Mortgage Mom, and today we are going to be talking about refinancing since interest rates are still continuing to come down, which is fabulous. So we're going to talk a little bit about that first, and then we'll jump into refinancing in case that is something that you've been considering, that you want to do. I want to make sure that you understand all of the aspects of how refinancing works. How do you get the interest rate that you get, because those things are very important. So let's first talk about the first thing we're going to jump into is why are the experts saying that we've got a 90% chance at this point of the Fed cutting interest rates. So what has happened this week that is pushing them to believe that that is absolutely 100% coming? So I think that that is very important to discuss. But before we jump into that, I just want to remind everybody that this is an interactive show. You are more than welcome to put your questions into the chat, right into the feed. I will read them out loud. I will answer them for you. I want this to be interactive. I want you to get engaged. If you're here and you're watching, give me a thumbs up, tell me hi, let me know where you guys are at that you're watching from. But I do want to make sure that I get the information to you that you are looking for. So make sure that you do ask those questions. So let's go ahead and let's jump right into why are those experts saying that there is going to be a rate cut next week. And of course, next week on Wednesday is when they will make the announcement. I will be doing my show live at 1 o'clock as always, and I will be able to give you the answers because they typically come out right about 11:30, 11:15-ish Pacific Standard Time. So I will be able to give you what happened, what did they say, read the press conference for you, let you know if it looks like we might get another rate cut at the next meeting to follow. So we're going to go through all of that next week. But why do these experts think that we are going to see that rate cut next week? What is going on? So we know from all of the years that I've been doing this show, and since interest rates started to climb and the Fed started to increase rates, we've been talking about what the Fed is saying. What do they say when they do those press conferences? What are their two big issues that they are concerned with that would make them lean towards a rate cut? So it's always been a dual mandate. One of those things that they are talking about is unemployment or employment on its own. So if they see that employment starts to take a hit, they don't want that to happen. That is one of their mandates that they have vowed to protect. So what happened this week? Well, we got our JOLTS report. The JOLTS report is basically a jobs report that is, who's hiring, what jobs are available for people to interview or put in an application for. And that number actually came in lower than expected. So there were less job openings available than what they've been anticipating. So that is one of those mandates that the Fed has always said that they were going to try to protect. They did not want to see employment start to take a hit. So there we go. There's number one. The other thing that they wanted to see is, the inflation. Inflation is looking better than it was. Obviously, they still have their concern that things could go the opposite direction with the tariffs. But the last inflation report that came in was actually right on target and still sub 3%, which means that we are moving in the right direction. So things are definitely looking as though they are cooling off, and the Fed cannot allow things to cool off further than, necessary, because that could then end up spiraling us out of control. So again, these are the things that that the Fed has been saying that they are weighing their hat on when making a decision as to whether or not they are going to cut those rates. And so this leads our experts to believe that we are going to see a rate cut come next Wednesday. So fingers crossed for that. So what is happening in the meantime? So as each report comes out, which we've talked about, there's these reports that come out. And as the reports come out, the investors start to move money around, and there's reaction, and then there is anticipation. And that is what really starts to move rate sheets. So as of last week, we had finally broken through an 11-month barrier. You guys heard me talk about that. And I told you guys that we needed to see that break. It was very, very little. We barely broke through the 150, right? We barely broke through that 1.50, but we did break through it, and we broke through it very, very softly. As of today, because of that JOLTS report, and Bloomberg came out with an article, and they were talking about how mortgages are a great investment right now, especially when we move into a little bit more of volatile times. Mortgages are always a good place to put your money because it is stable investment. And so with that, it looks like we are kind of really running as of today. So it's taken a week. We kind of broke through that barrier. We fell back through it a little bit on Friday, broke back through it a little bit yesterday. But today we are actually up 25 basis points. And last week's show, we did talk about basis points. So if you do want to know what those are, go back and watch last week's episode, because I do give you guys the definition of what basis points are. But we broke through, and right now we are at 175, which is much, much better than where we were. So we've kind of blown that barrier finally today. And I did tell you guys we needed to stay above that 150 for at least a couple of days. We really struggled to stay above the 150. We even on Friday, actually it was either Friday or yesterday. It was actually probably yesterday. But we kind of fell below that 150 and kind of moved back into those 140s, 147. But we've been kind of remaining very calm and stable for about the last week or so. But we did finally break through that barrier today with those different announcements and reports that came out. So this is great news. This means that our interest rates as of today are still continuing to move downward, which is fabulous. Now, last week, we also talked about if the Fed does cut rates next week, which it is looking like they are going to, that is not necessarily going to move the needle in interest rates. Interest rates for mortgages, will it move the interest rate? Yes, it will, for home equity lines of credit, credit cards, short-term loans, car loans, student loans, things of that nature. But mortgages are not tied to the Federal Reserve prime rate. Sure, it works its way into it, but they are not tied to it. They are actually tied to reactions, just like the stock market would be, anticipation, reports, news. So we are already seeing this rate cut being built into these rate sheets. And we already saw that really last week. And then today really just kind of put that stamp on, we really do believe it's coming. And so we're starting to see that improvement even further today, which is great. So by next Wednesday, we will have already seen all of the improvement that we are going to get. But the good news is that interest rates are on their way down. With interest rates on their way down, we're going to have a lot of people that are going to be interested in doing a refinance. So I do want to talk about that. Who should be looking at doing a refinance? How does it work? There's multiple ways, and there are different reasons why different interest rates are quoted. So I think that this is very important for you to understand, especially for the clients who may want to be consolidating a first mortgage and maybe a home equity line or a home equity equity loan that they have taken over the last 3 years, because that has kind of been the very best route for most homeowners to be able to access cash with keeping their mortgage payment as low as they could. I can see Why Not jumps on and he says, happy Wednesday. Also, happy Wednesday, Why Not? So happy to see you here. And again, I want to remind everybody, this is interactive, so please feel free to ask me your questions, put your comments into the feed. Happy to read them out loud and answer them for you. So how does it work? Why do people get different interest rates? Consolidating a first and second, okay? And when I talk about a second, that would be a home equity line of credit, or that would be a second mortgage. They are both liens that are tied to your property, and they are in second position on the title of your home. So we refer to them as second mortgages, okay? So if you have a second, you've got a second lien of some sort. So when we consolidate a first and a second together in one, that is considered a cash out refinance. When you do a cash out refinance, even if you are not pulling out money, and so this is very important for you guys to know, even if you are not getting cash in hand, all you are doing is consolidating a first and a second. For most loan programs, I'm going to talk conventional right now, VA right now. FHA does work a little bit different, but if you pulled out that line of credit within the last 12 months, or you have taken a draw against it within the last 12 months, FHA would also be part of this. So most mortgage programs consider it a cash out when you pay off a second loan, unless that second loan was taken out for the purpose of purchase money. So when you bought the house, you actually secured 2 liens at that time. That is considered a rate and term to put those loans together into one. But if you took that second mortgage out at a different time, later on, after you purchased the home, you pulled cash out to pay off debt or to do home improvements, it is considered a cash out. When you do a cash out refinance, you are going to get a higher interest rate than what you would get if you were just doing a rate and term refinance. So if your mortgage balance when you bought the property was $700,000 and your mortgage balance today is $695,000, and all we're doing is refinancing that current mortgage balance, that is a rate and term refinance. If we are paying off a second lien that is tied to your property that you took after the date of your purchase, then that is going to be a cash out refinance. That cash out refinance is going to give you a higher interest rate. Now, if you just do a new refinance, you don't have a home equity line of credit, we're not consolidating anything, but you do want to pull out $5, $10, $15, $30, $90,000, $100,000. You want to take cash in hand from your refinance, that is still going to be considered a cash out refinance. So when we do a cash out refinance, you are going to end up with a higher interest rate than if we do a rate and term. So I have a bunch of clients right now who I'm in the middle of speaking with who have taken out home equity lines, or they are interested in getting out some cash. They need to get some debt paid off, or they've got some home improvements that they'd like to get done. And they are wondering if they should be waiting for interest rates to come down just a little bit further. And let me tell you what I am explaining. So in the scenario that we can consolidate or possibly pay off, get the cash out and pay off debt, and we can keep your mortgage payment very, very similar to what you pay today, even with your low interest rate, then it is worth it to do a refinance right now, because when interest rates do drop further, which we all know that they will, this is not going to be the one and only rate cut that the Fed is going to do. This is just the beginning. Now, will they cut at the next meeting? Maybe not. It might be exactly what happened this time. In 2024, we got 3 rate cuts. In 2025, this will be our first. So could we end up with another 1 or 2 rate cuts this year? We could. We might not. But will we end up with some rate cuts in 2026? Me personally, Mortgage Mom Radio, my lens, knowing what I know after 30 years in the industry, I would say we will see more rate cuts. So as we see more and more rate cuts, interest rates are just going to also follow suit. We are going to see them, come down further. So as they come down further, if we do the cash out refinance right now, and we get that done right now, and we can keep your mortgage payment very close to what you have already been paying, then the next loan that you do is going to be a rate and term refinance. That is very, very important. Why? So yesterday I quoted a loan, and I was talking to a client, and I said, if we do the cash out refinance right now today, your interest rate is going to be 7.25%. And now, again, everybody gets a different interest rate, okay? So this was for this client. Maxing them out, 80% loan to value, cash out refinance, 720 credit score, their loan amount. So this was for them yesterday, okay? Conventional yesterday. So we're going to talk about conventional FHA, all that. We're going to get into that. But with the conventional 7.25% for the cash out refi, if we had done a rate and term refinance, that interest rate for that client would have been 6.75%. Okay. So we're talking about 0.5% is the difference in interest rate. That is a very big difference. So as interest rates start to come down, if you've already sucked it up, taken the higher interest rate, got it all consolidated together, kept your mortgage payment in check with very close to what you've been paying, then as interest rates continue to fall, now you get to take advantage of those lower interest rates. Now, I am not going to tell you that every single client would get those interest rates. That's not necessarily the case. I have other clients that I am quoting rate and term refinances right now that are conventional loans that are at 6.5%. I have FHA loans that I am quoting right now that are cash out refinances. And those cash out refinances are at 5.75%. So it depends on the type of loan that we do for you. It depends on your loan amount. It depends on your credit score. It depends on everything, your property type, your loan size. But the cash out part is a very big deal. So for my client yesterday, when we talked about doing his refinance, I could get him into an FHA loan at an interest rate of 5.625% instead of 7.25% for a conventional loan. The monthly payment was significantly less, even with FHA's monthly mortgage insurance. The payment was still significantly less, and his monthly payment was going to be the same for the amount of cash that he wanted. So in that scenario, it made more sense. Get the cash out you want, consolidate the second that you have, roll it all together into one brand new mortgage, one brand new payment. Take the hit for the cash out now. And then when interest rates fall further, we are now a rate and term refinance, which will make a big, huge difference. Interest rates will come down further. So not only will we be able to refinance him, put him back to a conventional loan, get rid of the mortgage insurance, but then also drop that interest rate and lower his monthly payment. So there are different strategies and different scenarios for every single client. Just because you hear a particular interest rate is the going rate and you think that conventional is the best option out there, why in the world would you take an FHA loan and pay PMI? You just don't know what the best option is for you until you reach out and you talk to somebody. We need to know the numbers. We need to know how much cash out do you need? How much is your home equity line of credit that you're trying to consolidate? How much do you owe on your current first mortgage? How much is your monthly payment right now? What is your current interest rate today? I had a client reach out last week. We talk all of the time, me and her. We've been in very close contact because she is in an adjustable. She is in a 7-year adjustable, and she is very nervous about it. I did not give her the loan. Somebody else did. But she is very nervous about her adjustable, and she wants to be able to refinance to get into a fixed interest rate as soon as she can. And when she called me and we talked, I flat out told her, you're only 3 years into your 7-year adjustable. Your interest rate and monthly payment today is better than what you could get if you went into a 30-year fixed rate. Do not do this right now. I had another client reach out that was also interested in wanting to possibly consolidate. She heard my show last week. I asked her how much she owes on her home equity line of credit. It wasn't very much. How much did she owe on her first mortgage? Her first mortgage balance was significantly higher than what her home equity line of credit is. Her interest rate on her first mortgage was so much lower that when we combined the two together and I looked at what she was paying as a blended interest rate, she is paying 3.37% right now between her two mortgages. It does not make sense for her to do a refinance right now. It just does not. But many of you, it does make sense. Many of you have home equity lines of credit that are $100, $150, $200,000. And for some of you, even higher. Many of you have interest rates that are 4.5%, 5%, and the equity line of credit. Many of you have an interest rate that's 3.75% and a high home equity line of credit. And in that situation, it very well may be worth putting those two together. But there is just no way to know unless you reach out to me and you talk to me about what you have, what you are looking to do, and what your goal is. And then I am going to tell you whether or not it makes sense. So Armando popped into the chat and he says, me. But from what I remember with Armando, he's got a low home equity line of credit interest rate. It was an introductory line of credit interest rate. So I don't know if that has moved for him yet. If I remember correctly, his first mortgage was also a very decent interest rate. If I remember correct, it's been a little bit since me and Armando have chatted. But for him, I would once again just have to ask the same questions. Remind me again, what is the interest rate on your home equity line? Has your introductory rate gone away? How much do you owe on it? What is your balance on your first mortgage? What is your interest rate on your first mortgage? And is there something that we can do that is better? And I'm going to be very open, very honest and tell you, yes, you should. No, you shouldn't. The numbers do not lie. I'm not going to be able to twist something and tell you that you should do something that you shouldn't. The numbers do not lie. Now, I do want to get on one more thing that I want to remind everybody of. Back during the COVID days, which were phenomenal, interest rates just continued to go down and go down and go down and go down. And we had clients that refinanced numerous times between 2019 and 2022. And every time they'd refinance, they'd pull cash out and they were able to lower the interest rate, which kept their mortgage payment the same. Now, let me remind everybody, if you want cash out of your home, you are increasing your balance. Interest rates are not dropping through the floor like they did during COVID. If we are struggling right now to find a way to keep your monthly payment similar to what you owe today on what you are paying today. So whether that is just one mortgage or if that is two mortgages, whatever those two payments are on those two mortgages, whatever that number is that you are paying today, if you are looking to take extra cash out, there is no possible way for us to get you more money in hand, increase your loan balances, and your monthly payment doesn't go up slightly. So you do have to take that into consideration. Money is not free. I'm going to say that during COVID, it was very close to free. But that's not the day and the time that we're in right now. So please keep that in mind. If you have a first, if you have a second, and you have two payments, we got to look at what those payments are. The number one goal is can we put those together and can we make the payment remain the same? Is that possible, or can we get it close? Then if you want extra cash out, can we do it in a way? What is the cheapest way to do that? Do we rewrite that line of credit for you, or do we rewrite everything for you? And we're looking for what is the cheapest way to do that, but don't think that your payment is going to remain the same and you're going to get cash in your pocket. That is going to be a very, very tall, hard task to complete. So I can see Armando jumped in and says, yes, that is correct. HELOC 3.85 rate ends in 2027. I will reach out. So Armando, you are good, man. You have got time to just ride the rainbow for the next year. You've got all of 2026 to ride the rainbow to see kind of where interest rates do end up. You are somebody that does not need to hurry up right now. Nicholas Mosqueda gets on and he says, me 3.25 now. So yeah, Nicholas, 3.25 is a fabulous interest rate if that is what's on your first mortgage or even on your home equity line of credit. But if you have a home equity line of credit and you owe a decent amount on it, it's a pretty good balance and it's a high interest rate, then that is where we'd want to talk to you. If you were looking to try to pull cash out, that is something that we want to talk to you. What's the cheapest way to get your money out? So these are things that we are going to have the discussion, and we're going to run the math, and we are going to figure out what is the cheapest way to obtain the goal that you have. And that is what the direction should be. That is what the game plan should be. Now, let me get on to this FHA thing and VA. So a lot of my clients purchased homes in 23, 24, and this year 25. The average interest rates have been above 7%. Some of you 6.75. If you are below 6.75, you either paid points, seller paid points, or you did a buy down on your loan, and your buy down is only going to last for so long as well. So if you are somebody that has bought a home between 2023 and today, and you have an FHA loan or a VA loan, we need to be talking right now, because we are looking at streamlined refinances, which are not available on conventional loans. Streamlined refinances have phenomenal interest rates. We pull your credit report. We get a utility bill to prove that you still live in the property. We get a mortgage statement to make sure that you have been making your payments on time. If you're in a condo, we'll get your HOA statement to make sure that that number hasn't changed. Just that everything is in good standing is what we're looking for. We do not need W-2s. We do not need pay stubs. We do not need an appraisal. And the last time that I ran an interest rate on a streamlined refinance, we were in the low fives, you guys. Low fives. So if you have an interest rate that is 6, 6.25, 6.5, 6.75, or above 7, and you have an FHA or a VA loan, you should be reaching out right now, because we can do a streamlined refinance very, very simply. And not only that, but you can do a streamlined refinance for FHA every 210 days and 6 payments made, and for VA every 240 days and after 6 payments have been made. So basically, just about every 6 payments that you make, you can do another streamlined refinance, which is just rewriting your mortgage for a lower interest rate. So if you have a loan that you took, again, this is not cash out, you guys. This is a rate and term. We are just rewriting the terms of what you have today. If you have a VA or an FHA loan, we can do that for you. Now, let's go back to my story at the beginning. My client that's trying to figure out how to get some extra money out of his house. He's got a first, he's got a second. And I said, hey, if we consolidate it all and we get you the extra cash out, the payment's going to be very similar to what you pay today, plus the extra 30 grand that you're looking for in cash, right? So what he pays today plus the extra 30 grand, what's that going to cost you all in total? We can do an FHA loan today. We can get him all of it consolidated, get him the cash, and just get one payment going. And we can get past that cash out hump, right? So for him, in the future, he could, as I mentioned, go back to conventional, drop the mortgage insurance and do all of that jazz. Or depending on where interest rates are, because remember, FHA and VA loans have much, much lower interest rates. Remember what I told you guys. I was quoting him 5.625 versus 7.25. FHA versus conventional. Big, huge difference, right? So he may choose to just stay in that FHA and do a streamline in 6 months. Maybe those rates get down into the fours. Maybe that is still cheaper than doing a refinance to conventional. So again, with every single loan that we do, every single client, every single scenario, and every single situation, we are going to determine what is the very cheapest way to get the money or get the refinance completed. What is the cheapest way, the best interest rate? What is the best way to keep your payment as low as possible? So I hope that helps just kind of get you guys thinking. If you have a conventional loan, again, FHA, VA, if you bought a house between 2023, really end of 2022, things started to skyrocket, but end of 2022, 2023, 2024, and this year, 2025, you should be reaching out to me. We should be determining what that interest rate needs to be for the refinance to make sense for you. And then we make sure that we've got you on watch. So as soon as I see that interest rates hit that number, I reach out, I give you a call, I talk to you about it, and we get things started. That is very important. There are so many of you out there who have worked with me in the past, and I absolutely appreciate that, and I love that, and I want you guys to come back to me again. There's many of you who did not work with me that still watch the show for your purchase, for your refinance, for your home equity line of credit. I can help you. I hope that you guys do understand and you can feel the sincerity in my heart. It is very, very important to me that we are pointing you in the right direction. Your family and your future come first, not my pocketbook. The math doesn't lie. We want to make sure that we are putting you and pointing you in the right direction. I am never, ever going to talk you into doing something that just absolutely does not make sense because it's a benefit for me. I'm going to show you the numbers, and you are going to be the one that drives the decision as to whether or not it makes sense to move forward with the transaction. So with that, I hope that makes sense. I am super excited about next week, next Wednesday, right here at 1:00. I'll be able to tell you guys exactly what the Fed said. I'll be able to update you guys once again. Our interest rates continuing to drop. This is the third show now that I've done that I've said interest rates are getting better, which is phenomenal. We want that to happen every week. We've all had bad news for 3 years. It is about time that there is a smile on my face and that I'm bringing you guys good news, not just education. And an opportunity to get out there and buy a house if you haven't bought one, because interest rates are coming down. That makes homes more affordable. There's a little bit more inventory sitting out there right now. Sellers aren't selling their homes as fast as they were, so you've got a little bit more negotiating power right now. So this is all really fantastic, and I'm super looking forward to it. So let's talk next Wednesday. Don't miss out. Be right here at 1:00. If you don't know when I go live, you don't get my text message, make sure that you opt yourself in. Text the word live to 844-935-3634. That is also the number to call my office. So once again, 844-935-3634. That's 844 We Lend for You. WELEND and the number 4. Jump on my website, you guys, mortgagemomradio.com. I've got calculators, a contact us. You can send me an email. If you've missed any of the shows and want to listen to it by podcast is on the website. You guys have every way to get a hold of me. You can text any number that I've got. You guys can email me. It's really not a problem. I want you to reach out. I want to help you. I want to guide you. And I want to make sure that we know what we should be waiting for and looking for to be able to strike at the right time. So I hope you guys all have a fabulous rest of your week. I will be back again next Wednesday at 1:00, and we'll talk real soon. Bye-bye.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. Pick up the phone and call mom.